Welcome back to Investing Talk Podcast.
Today we're looking at Planet Labs.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. This company, which is transitioning from, a space operator to a data platform, seems to have hit a major inflection point.
A huge one. And it looks like the latest quarterly results were the real catalyst here.
They really were.
Okay, so let's just start with the numbers, because the revenue acceleration alone is, well, it's pretty striking.
It is. We have to highlight the record Q3 FY26 revenue. It hit $81.3 million.
Which is 33% year-over-year growth.
Exactly. And to put that in perspective, they were compounding at about, 23% before? So that jumped to 33%.
Mm-hmm.
It's a big signal.
It's a huge signal. It suggests the underlying demand is picking up, but I think, more importantly, their execution is getting much, much better.
And we know exactly where that's coming from. It's the shift towards locking in these larger, longer-term contracts.
The sticky ones.
The really sticky ones, yeah. We're talking about massive government and defense customers. Wins like the NGA Lino B contract, expanded deals with NATO, and these crucial U.S. Navy awards.
And when you land those kinds of contracts, you're not just getting revenue, right? You're getting validation.
Yes.
You're getting a multi-year commitment.
Right. And that fundamentally changes the risk profile of the business. For a company with a SaaS-like model, the key thing isn't just current revenue, it's forward visibility.
How far out can they see their cash flows?
Exactly. And this is where the numbers get, frankly, a little astonishing. If you look at their remaining performance obligations, their RPO.
So future revenue that's already signed and contracted.
Right. That metric jumped an incredible 361% year over year.
361%. Their total backlog nearly tripled to $734 million.
It's almost unbelievable in this sector. And they said roughly 60% of that RPO is expected to be recognized over just the next 2 years.
That's why analysts care so much about it. It means their future growth isn't speculative. It's largely locked down.
It completely de-risks the growth story. And that visibility is what lets us talk about the next big thing, which is the transition to profitability.
The most critical inflection point.
Absolutely. The company just hit its 4th consecutive quarter of positive adjusted EBITDA.
4 quarters in a row. That's starting to look like a real trend, not a fluke. But, does that positive story go beyond just the adjusted metrics?
It does, and that's the encouraging part. The cash flow story is also really strong. They were free cash flow positive in Q3.
Not by much, but it was positive, $0.9 million, I think.
Right, but positive is positive.
Yeah.
And year-to-date, they've generated $113.7 million in operating cash flow, which led to $55.2 million in year-to-date FCF.
Which is crucial. It means they're now generating the cash they need to fund their own operations. They're moving to a self-funded growth model.
That self-funded growth narrative is huge for investors, right?
Mm.
It removes that constant threat of equity dilution.
And management backed it up by raising their full-year guidance.
They did. They bumped the revenue guidance up.
Yeah.
But the big headline was the guidance for their first ever full-year adjusted EBITDA profitability. They're expecting $6 to $8 million.
That's the textbook definition of an inflection point, moving from burning cash to generating a profit on a full-year basis.
And they have the cash to see it through. The balance sheet is really strong. They've got, $677 million in cash and investments?
Yeah, and that's after raising that $460 million in ultra-low coupon convertible notes. It seems like they're using that cash very strategically for high-return investment.
Exactly. Building out the next-gen constellations and, critically, their AI platform. They are investing heavily to secure their future moat.
Okay, so that's a perfect transition. Let's talk about that competitive moat. Beyond the numbers, what are the things that will secure their dominance 10 years from now?
Well, it has to start with their raw scale and their revisit frequency.
The ability to see almost any spot on Earth every single day.
Right. They operate one of the largest commercial Earth observation fleets out there. You have the SuperDoves for wide area scanning and then higher-res SkySat fleet. No one else really matches that combination of breadth and daily revisit.
But scale alone isn't enough these days, is it? The key seems to be that they're not just taking pictures, they're putting AI directly into space.
This is the real game changer. The Pelican and Owl constellations.
Tell us a bit more about those.
So take Pelican. It offers much higher resolution. We're talking 40-centimeter class. And this is the key part. It integrates NVIDIA Jetson AI at the edge.
So the processing happens on the satellite itself, in orbit.
Exactly. So instead of sending down petabytes of raw pixels and then running analysis, the satellite itself can flag an anomaly like a new ship in a port and only send down that critical piece of data.
Which dramatically reduces latency. You get actionable intelligence, not just data.
Precisely. And that leads directly into the data network effect,
Yeah.
which is the layer that competitors just can't easily replicate.
That massive historical archive of daily global images going back years.
That's the real barrier to entry. To train the kind of sophisticated AI models you need for this, you need that uninterrupted, high-quality historical data. You can't just create a decade of daily global imagery overnight.
And it creates enormous switching costs for their big government clients, right? The NGA, the US Navy. They're not just looking at photos, they're baking this data deep into their mission-critical workflows.
Which is why the software and analytics layer is so important. That's where the higher margins are. And their acquisition of Bedrock Research was a huge step in that direction.
Right, strengthening their AI and machine learning so they can move from selling raw images to selling, anomaly detection and global monitoring subscriptions.
It lets them become a solutions provider. And all of this is capped off by that government validation. The consistent renewals with the NGA, NRO, NASA, that's a trusted vendor status that's almost impossible for a new entrant to get.
Okay, so with that fundamental story in place, let's talk about the price action. The market has obviously woken up to this. The stocks had a massive run.
A huge run, yeah. Up something like 500, 600% over the past year, and it jumped about 36% right after that Q3 earnings report.
That's a major technical breakout from what was a multi-year base. The price is well above its key moving averages, which signals a really strong uptrend.
And for anyone tracking the technicals, that prior resistance area, around the mid-teens, say $14 to $16.
That now becomes the first level of support.
Exactly. Technicians see that as a high probability buy zone on any pullback. And that's mirrored in the overall sentiment. All the headlines are bullish.
And the analysts are following right along. We saw Wedbush and JMP Securities raise their price targets almost immediately.
When the analysts, the financials, and the price action all move in lockstep like that, it adds a lot of weight to the bull case.
Okay, but we have to be balanced. Let's talk about the bear case. What are the risks here?
Well, the first one is the durability of this new profitability. While the adjusted EBITDA story is good, we did see a little compression in non-GAAP gross margin.
And more importantly, the Q4 guidance implies a temporary step back.
Right. They guided to an adjusted EBITDA loss of between $5 and $7 million for the fourth quarter. Management says it's for seasonal launch costs. But for an investor, seeing it dip back into the red is a point of friction.
Then there's the valuation. After a run like that, a lot of future growth is already priced in. And the bearers will point to the GAAP losses.
The big Q3 GAAP net loss of $59.2 million. They'll argue that despite the positive adjusted numbers, the underlying business is still fragile.
And there's execution risk. They're still heavily reliant on a few huge government contracts, which means they're vulnerable to budget cycles.
And, space is hard. There's always the risk of a launch failure or a delay with the new Pelican or Owl satellites.
Right. And we should probably mention the insider selling. We saw the CEO and others selling shares after that massive run-up.
We did. But you have to contextualize it.
Yeah.
It's likely just standard executive diversification after a 500+% move. I mean, if the fundamentals were truly broken, you wouldn't see analysts upgrading their targets at the same time.
So what does this all mean for you, the listener? The core thesis that Planet is transitioning from a high-cost speculative story to a profitable, cash-generative, high-moat platform. Well, it seems to be real.
It's backed by that massive tripling contract backlog, and it's supported by these really long-lasting demand tailwinds in geopolitics and climate monitoring.
So it raises a really interesting question for their next phase of growth.
It does. I mean, what happens if Planet successfully integrates its proprietary data archive with its new Bedrock AI platform to offer truly global, real-time anomaly detection?
Could they transform from just a data provider into something more?
Could they become the de facto operating system for defense and intelligence agencies worldwide? If so, that would fundamentally transform their valuation forever.
That's a huge fundamental shift to consider. If you want to keep track of this company and others reaching such a critical inflection point, make sure you subscribe, like, and leave a comment to stay up to date with all our market analysis.